Most people assume banks trust borrowers based on income, or credit scores, or how long they've had credit. But that's only part of the story, because inside modern lending systems, some customers quietly earn a reputation, not with a banker, not with a loan officer, not with a person at all, with the models themselves. These borrowers often receive stronger approvals, higher limits, better offers, and fewer obstacles. Not because they're rich, not because they're gaming the system, but because they fit a category lenders love: low effort, high trust, or in simple terms, the borrower banks never have to worry about. This is Credit Cipher, and today we're decoding the secret low-effort, high-trust customer profile banks love. And the funny thing is, most people spend years trying to look impressive, when banks are usually looking for something much simpler: predictability. Because modern underwriting isn't trying to figure out who you are today, it's trying to estimate who you'll be tomorrow. And once you understand that, a lot of lending decisions suddenly start making sense. A common misconception is that banks are searching for perfect borrowers. They aren't. Perfect doesn't exist. What banks really want are fewer surprises, because surprises create uncertainty, and uncertainty creates risk. A borrower who suddenly changes spending habits, suddenly opens multiple accounts, suddenly carries larger balances, or suddenly behaves differently than before, becomes harder to predict. And prediction is the entire game. After all, banks aren't lending money to your past. They're lending money to your future. So every underwriting system is quietly asking, what is this person likely to do next? Not next year, not 5 years from now, soon. And the easier that answer is, the more confidence lenders have. That's where trust begins. Not with perfection, with consistency. One of the strongest signals banks look for is utilization stability. Not just whether utilization is low, but whether it remains relatively stable over time. Because stable behavior suggests control. And control is something underwriting systems love. Imagine two borrowers. One uses around 15% of their available credit month after month. Nothing dramatic, nothing unusual, just steady behavior. The second borrower swings between 5%, then 70%, then 10%, then 80%. Neither borrower is automatically bad, but one profile is much easier to understand. And easier to understand usually means easier to trust. Think about it this way. If someone drove their car at a steady speed every day, you'd have a pretty good idea what to expect. If someone alternated between driving 20 miles per hour and launching themselves into low orbit, you'd probably have questions. Banks do too. Another major trust signal is account maturity. Time matters, because time filters out randomness. Anyone can have 6 good months. A few good years? That's harder to fake. Long-standing accounts create a history lenders can evaluate, a pattern they can study, evidence that behavior isn't temporary, it's normal. And that's incredibly valuable, because the longer positive behavior continues, the more believable it becomes. Eventually it stops looking like effort and starts looking like identity. This is simply how the borrower operates. The next signal is something I like to call financial rhythm. Income comes in, spending happens, balances get managed, the cycle repeats. Nothing dramatic, no financial fireworks, no sudden chaos, just a consistent pattern. Banks pay attention to rhythm because rhythm reduces uncertainty. A predictable financial cycle is easier to model than an unpredictable one. And easier models usually produce stronger lending confidence. It's not exciting, but exciting isn't the goal. Exciting is great for movies, not underwriting. This is where many people get confused, because they assume a strong credit score automatically creates trust. Sometimes it does, sometimes it doesn't. A score measures outcomes. Underwriting systems often analyze behavior. Those are related, but they're not identical. Imagine two people with the exact same score. One built that score through years of gradual account growth. Stable utilization, consistent habits, measured activity. The other achieved the same score while rapidly opening accounts, changing spending patterns, and generating more uncertainty. Same score, different story. And banks don't approve scores, they approve risk. That's why two borrowers can appear similar on the surface, yet receive very different outcomes. The underlying behavior matters, sometimes more than people realize. And here's the part nobody likes hearing. The strongest profiles are often the most boring. No secret hacks, no magic formulas, no clever loopholes, no viral strategy someone discovered 3 weeks ago and swears banks hate. Just consistent behavior repeated over long periods of time. Because trust compounds. Every month of stability adds another data point, another signal, another reason for lenders to feel comfortable. Eventually, the system stops asking, "Can we trust this borrower?" and starts asking, "Why wouldn't we?" That's when things begin to shift. Approvals become easier. Limits often grow faster. Future lending decisions become smoother, not because someone beat the system, but because the system understands them, and understanding creates confidence. When underwriting systems evaluate applications, they're ultimately searching for predictability. Predictable spending, predictable account management, predictable financial behavior, because the easiest customer to lend to is the customer that's easiest to forecast. That's the foundation behind the low-effort, high-trust profile. Not wealth, not luck, not secret tricks. Just consistency repeated long enough to become believable. And once you understand that, you stop trying to impress the system and start giving it clarity. That's Credit Cipher. Subscribe, hit the bell, and join us for the next Decode. And I'm curious about your experience. Have you ever been approved for a credit card, loan, or credit limit that completely surprised you? Or denied when you thought approval was guaranteed? Drop a comment below. I want to hear what happened, because those stories usually reveal more about how these systems think than people realize. Next, we're diving into one of the biggest myths in personal finance: why some people pay their credit cards in full every month and still end up with weaker credit growth than expected. Because sometimes, doing what sounds responsible isn't always sending the signal you think it is, and that's where things get interesting.